Hi everyone, welcome back to Books and Backbone. I'm Donna Harris, CEO of Bookkeeping Made Simple, your host, and today I want to talk about one of the most valuable tax deductions available to small business owners, one that most of them don't know about, don't fully understand, or aren't capturing correctly. And that is the Qualified Business Income Deduction, the QBI deduction. If you're an S-Corp, an LLC, a partnership, or a sole proprietorship, and partnerships and sole proprietorships do come under the LLC umbrella if they're set that way, then this deduction was created specifically for you. It allows you to deduct up to 20% of your qualified business income from your taxable income. And as of July 4th, 2025, when the One Big Beautiful Bill was signed into law, it's permanent. Not temporary, not subject to expiration, permanent. For a business owner in a high tax bracket, this deduction can save tens of thousands of dollars a year, easily. And yet I consistently account business owners, smart, experienced, professional business owners, who can't tell me what their QBI deduction is, whether they're claiming it correctly, whether their tax preparer has claimed it for them, whether their books are set up to support it. And today I'm going to fix that. So let me start at the beginning because I think that the name itself creates confusion. Qualified Business Deduction, QBI. What does that actually mean? Well, qualified business income is the net income from a qualified trade or business, like, for most small business owners, S-Corps, LLCs, taxes, partnerships, or sole proprietors, it's essentially the profit from the business after deducting ordinary business expenses. And that's one of the things I really like about just being in business, is that the ordinary business expenses to start with are essentially tax-free. You're not taxed on the money that you spend to grow your business. You're taxed on your profits. So your QBI, or qualified business income, is your profit. It is the profit from the business. Your revenue less your ordinary business expenses is your QBI. And the deduction allows you to deduct up to 20% of the qualified business income, or basically profit, from your taxable income. Not from your business income, from your personal taxable income. This is not available to C-Corps. This is a below-the-line deduction, which means it reduces your taxable income even if you take the standard deduction. So to make it clearer, let me put it in dollar terms. If your S-Corp generates $200,000 in qualified business income, and you're in the 37% tax bracket, the QBI deduction reduces your taxable income by $40,000. At a 32% margin rate, let me double check that number, 37% marginal rate, that's nearly $15,000 in tax savings in a single year, every year, permanently. This is not a trivial number. This is a car payment. This is a college fund contribution. This is a reinvestment into the business, and it's available to you right now if you're running the kind of business in the right structure, the right kind of business in the right structure. So let me talk about who qualifies, and there are limitations, and understanding them is important. The basic rule is that, say, any income from a qualified trade or business passed through to the owner on a Schedule K1 or Schedule C is potentially eligible for the 20% deduction. So that already covers most S-Corps, most LLCs, most partnerships, and most sole proprietorships. There are two places where limitations kick in. First, there's an income threshold. The QBI deduction begins to phase out for taxpayers with taxable income above about $197,000 for single filers and $394 for joint. Above these thresholds, so you have a lot of room. If you're making less than $200,000 as a single person, if you're making less than $394,000 as a married couple, you can take this. This limitation does not apply to you. Above these thresholds, I'm going to glitch again, I swear. I get tired, and then sometimes I can't say what I'm thinking. Above these thresholds, the W-2 wage limitations and other restrictions begin to apply. The OBBA expanded these phase-out ranges, making the deduction accessible to more business owners at higher income levels than before. The second limitation applies to what the tax code calls specified service trades or businesses, or SSTBs. These are businesses in fields like law, health, consulting, financial services, and certain others, where the principal asset of the business is the reputation or skill of one or more of its employees or owners. If your business falls into the SSTB category and your income exceeds the phase-out threshold, your QBI deduction may be limited or eliminated entirely. And I want to be transparent here. Bookkeeping is not on the SSTB list. Neither is engineering, architecture, or most trades. The list is specific. And if you're not sure whether your business qualifies, that's a conversation to have with your tax preparer. And now here's where things get a little technical. I'm going to try to keep it as plain as possible, and it's a little bit hard to do because it is kind of esoteric. The basic calculation is 20% of qualified business income. Simple. But above the income thresholds I mentioned, $195,000 for singles and $394,000 for married couples, if you're above those income thresholds, the deduction becomes the lesser of 20% of qualified business income, or the greater of 50% of W-2 wages paid by the business, or 25% of W-2 wages plus 25% of the adjusted, 2.5% of the adjusted basis for qualified business property. Now, I know that sounds complicated, and it's kind of a pain. But here's the practical implication. If your S-Corp is above the income threshold and you are not paying yourself a reasonable W-2 salary, your QBI deduction may be significantly limited because the limitation is capped at 50% of W-2 wages paid by the business. Okay? This is why owner compensation matters. This is why I've talked about it on other episodes. This is why it matters so much. The owner who pays themselves a W-2 salary, or a salary that's unreasonably low, if they don't take a salary or they take a very low salary, they may be reducing their QBI deduction in addition to creating other tax problems. The sweet spot for most S-Corp owners above the income thresholds is a reasonable W-2 salary, which is required by the IRS anyway for S-Corp owners who are actively working in the business, combined with a pass-through distribution that benefits from the QBI deduction. Okay, let me say that again. The sweet spot for most S-Corp owners above the income thresholds. And these income thresholds, by the way, these are the profits of the business we're talking about. We're not talking about what you report. This is the profits of the business. Most S-Corp owners need a reasonable W-2 salary, which is required by the IRS for S-Corp owners who are actively working in the business. And I've talked about this. And we're going to combine it with a pass-through distribution that benefits from the QBI deduction. Now, getting that balance right is some of the most valuable tax planning conversations you can have. And it requires knowing your numbers. Specifically, what is the business earning? What does a reasonable salary look like for your role? And what is the resulting QBI deduction calculated? How is I know what I want to say, it's just not coming out. What the business is earning, what a reasonable salary looks like for your role, and what the resulting QBI deduction calculation produces. That's what I wanted to say. By the way, I don't edit my mistakes out. I will edit out things for guests, but I don't edit out my own mistakes because I want you to see that I'm a real person, with real problems and with a genuine enjoyment of helping business owners grow. So anyway, here's the honest part of this episode. The QBI deduction has been available since 2018. It's been in place for 8 years, and I still encounter business owners regularly who are not claiming it correctly or at all. And there's a few reasons. One is awareness. Some business owners genuinely don't know it exists. The tax preparer handles it or doesn't, and they've never had the conversation about whether they're capturing the full benefit. The second is that the books can't support the calculation. The QBI deduction is calculated from your qualified business income, which means your income and expenses need to be accurately recorded, accurately categorized, and current. A business with books that are 3 months behind or that have miscategorized expenses or have loans recorded as income cannot accurately calculate its QBI. The deduction gets estimated or understated or missed entirely. I want to say this again. Second time I'm repeating things, folks, because it's important. You cannot fully capture the QBI deduction without clean, accurate, current books. The deduction is calculated from the books. If the books are wrong, the deduction is wrong. The third reason is the reasonable salary question for S-Corps. Some S-Corp owners, and at least in my business, a lot of S-Corp owners are either paying themselves too little in W-2 wages, either because they don't know the rules or they're trying to minimize payroll taxes, and in so doing are inadvertently limiting their QBI deduction above the income thresholds. The fourth is entity structure. Some business owners are operating in a structure that made sense when they started, but may no longer be optimal given their income level, their growth trajectory, the permanent availability of the QBI deduction. The tight structure, the right structure for a business generating $50,000, $150,000 a year might be different from the right structure for a business generating $500,000 a year. And so here's what I want you to do with this information before the end of the year. First, confirm that you are claiming the QBI deduction. Ask your tax preparer directly. Am I claiming the full QBI deduction I'm entitled to? What was the deduction amount on my last return? Is there anything we should do before the end of the year to optimize it? Do not wait on this phone call, because once December 31st ends, there's nothing more we can do for the 2026 tax year. Second, make sure your books are clean and accurate. The QBI deduction is only as accurate as the books it's calculated from. If your books are behind, get them current before your tax preparer needs them. If your books have errors, miscategorized expenses, loans recorded as income, accounts that haven't been reconciled, those get corrected. Third, if you're an S-Corp owner above the minimum income thresholds, review your W-2 salary. Make sure you're paying yourself a reasonable compensation, which the IRS requires regardless of the QBI deduction, and make sure that salary is optimized relative to your QBI calculation. This is a specific conversation to have with your tax preparer, not a general principle to apply blindly. And what the IRS considers a reasonable compensation would be, how much do you have to pay somebody else to step into this role? Okay. Fourth, if you haven't reviewed your entity structure recently, now's the time. The permanent availability of the QBI deduction changes the math on pass-through versus C-Corp taxation for many business owners. A conversation with your CPA or tax preparer or accountant about whether your current structure is still optimal for your income level and growth trajectory is worth having before year end. And again, it has to be before year end. We can retroactively apply changes to the current tax year. Once the clock strikes January 1st, we can't make any changes for the 2026 tax year since we're in 2026 now. We'll be able to make changes for 2027 moving forward, but not for 26. So the QBI deduction is permanent now. It's available to you right now. And for most S-Corp and pass-through business owners, it represents one of the largest single tax savings opportunities available under current law. Whether you're capturing Whether you're capturing it fully depends on two things. One is whether you understand it, and now you do, and whether your books are clean enough to support the calculation. If you want to know whether you're capturing the full QBI deduction you're entitled to, or if you want someone to look at your books and tell you whether they're in the shape to support it, that's exactly what a financial clarity call is for. You can find me at mysimplebookkeeping.com. The first conversation is free. I'm Donna Harris. This is Books and Backbone. The deduction is there. Make sure you're getting it.